Welcome to Zimbudzi Investment Group. We're thrilled to have you here as you take your first steps towards smarter investing. Now, we know what some of you are thinking. Investing? Isn't that for people in fancy suits who shout things like buy, sell, into two phones at once? And look, maybe it used to be, but our mission as a company is to be your partner in turning that potential you have, that hard-earned money you've tucked away, into real, tangible prosperity. We're here to demystify the whole process, to take the scariness out of it. Because, let's be honest, the only thing scarier than investing is investing and realizing your money's been sitting there doing absolutely nothing, like a lazy roommate who doesn't pay rent. Here at Zimbudzi, we operate on a simple but powerful belief. The best financial decisions, the ones that lead to real, long-term success, are informed decisions. It's not about gambling or chasing some crazy hot tip you heard from your cousin's friend. It's about understanding the game, knowing the rules, and making smart plays. Think of us as your financial coach. We're not just going to tell you to run, we're going to show you how to stretch, how to pace yourself, and how to cross that finish line without pulling a hamstring. We want to empower you with knowledge so you can build a future that's not just stable, but thriving. So, to kick things off, we're going to break down the fundamentals. We're going to share 5 essential investing tips that every single beginner should know. These aren't complicated theories, they are the solid bedrock, the strong foundation upon which you can build your financial empire. Or, at least a very nice house with a really comfortable couch. This is your first, most important step toward navigating the world of investing with confidence and clarity. So grab a notebook, get comfortable, and stay tuned. Your journey toward financial growth starts right now, and we're genuinely excited to take it with you. Alright, first things first, before you put a single dollar, rand, or pound into anything, you need to ask yourself a very important question. Why am I even doing this? I know it sounds a bit philosophical for a finance video, but trust me, it's crucial. Are you saving up for a down payment on a house? Or maybe you're planning an epic trip around the world where you only eat pizza. Perhaps you're thinking long-term, like retiring early so you can spend your days perfecting your golf swing or just not having to work for the man anymore. Whatever it is, you need to define it. Setting specific, measurable, and realistic goals is like putting a destination into your GPS before you start driving. Without it, you're just burning fuel and going in circles. Saying, I want to be rich isn't a goal, it's a wish. A goal sounds more like, I want to have $20,000 saved for a house deposit in 5 years. See the difference? One is vague, the other is a target you can actually aim for. This clarity helps you determine everything that comes next. How much risk you're willing to take, what kind of investments you should look at, and how much you need to set aside regularly. It's the blueprint for your financial house. You wouldn't just start throwing bricks and cement together and hope it turns into a mansion, would you? No, you start with a plan, a vision. Your financial journey deserves that same level of intention and thoughtful planning from the very beginning. And let's be real, having that goal in mind is also your motivation. When the markets get a little shaky, and the news channels start screaming about a downturn, it's your why that keeps you grounded. It's the thought of that house, that trip, or that blissful retirement that will stop you from panic selling at the worst possible moment. Your goals are your anchor in the sometimes stormy seas of investing. They keep you focused, disciplined, and on track. So take a moment, really think about it, and write it down. What do you want your money to do for you? Once you know that, you're already ahead of the game. Okay, let's talk about a concept that your grandmother probably taught you, but it's one of the most sophisticated principles in finance diversification. You know the saying, don't put all your eggs in one basket. In investing, this is gospel. Imagine you put all your life savings into one single company, let's say a company that makes, fashionable hats for squirrels. For a while, business is booming. Squirrels everywhere are looking dapper. But then a new study comes out saying squirrels prefer to be bareheaded. Suddenly the company's stock plummets, and just like that, your entire investment is gone. All your eggs smashed. It's a tragedy for you, and frankly, for squirrel fashion. Diversification is your defense against this kind of disaster. It means spreading your money across a variety of different investments. We're talking different asset classes, like stocks, bonds, and maybe real estate. But it also means diversifying those classes, so instead of just one company's stock, you own shares in many companies across different industries: technology, healthcare, consumer goods, energy. The idea is simple. It's highly unlikely that all these different sectors will perform poorly at the exact same time. When tech is having a bad day, maybe healthcare is doing great. When the stock market is down, your bonds might be holding steady or even going up. This strategy doesn't just reduce your risk, it creates stability, it smooths out the ride. Instead of a terrifying roller coaster with huge peaks and terrifying drops, your investment journey becomes more like a scenic train ride with gentle rolling hills. It won't eliminate risk entirely, nothing can, but it significantly cushions the blows. It's about building a portfolio that's resilient, one that can weather different economic climates. Think of it like building a sports team. You don't just hire 11-star strikers, you need defenders, a goalie, and midfielders too. A well-rounded, diversified team is the one that wins the championship, and a diversified portfolio is the one that wins you financial security. Now we need to have a serious talk about risk. I know, it's the scary word, it's the monster under the bed of investing. But here's the thing, you can't avoid risk, it's part of the deal. The key is not to avoid it, but to understand it, respect it, and manage it. Pretending risk doesn't exist is like driving with your eyes closed. You might be fine for a second, but eventually, you're going to hit something. So let's open our eyes and look at the main types of risk you'll encounter on this journey. First up is market risk. This is the big one. It's the risk that the entire market will decline, pulling most investments down with it. Things like recessions, political instability, or even global pandemics can cause this. You can't control it, but by diversifying, as we just discussed, you can definitely prepare for it. Next, let's talk about liquidity risk. This sounds complicated, but it's simple. It's the risk that you can't sell your investment quickly for cash without taking a significant loss. Think about it. A share of a massive publicly traded company, you can sell that in seconds, that's very liquid. But what about a piece of fine art, or your share in a private business? Finding a buyer at the right price might take weeks, months, or even longer. That's illiquid. You need to be aware of how quickly you might need to access your money. If you're investing your emergency fund, you need high liquidity. If it's your retirement fund for 30 years from now, you can afford to have some less liquid assets. Finally, there's interest rate risk. This one primarily affects investments like bonds. When interest rates in the country go up, the value of existing lower-rate bonds tends to go down. Why? Because investors can now buy new bonds that pay them a higher interest rate, so the old ones look less attractive. It's a seesaw effect. Understanding these risks isn't meant to scare you away, it's meant to empower you. It's like a weather forecast. If you know there's a chance of rain, you bring an umbrella. You don't cancel your life. Knowing the risks allows you to make calculated decisions, not fearful ones. It turns the monster under the bed into a manageable and frankly kind of boring house cat. Let's be clear about something. Investing is not a set-it-and-forget-it appliance you buy from a late-night infomercial. It's more like a garden. You can't just throw some seeds on the ground, walk away for a year, and expect to come back to a beautiful, thriving oasis. It requires attention, it requires care, and most importantly, it requires knowledge. The world is constantly changing. New technologies emerge, consumer behaviors shift, governments change policies. All of these things can and will affect your investments. Staying informed and continuously educating yourself isn't just a good idea, it's your most powerful tool for success. You wouldn't fly on a plane with a pilot who stopped learning after 1975, would you? So how do you do this? It doesn't mean you have to become a day trader glued to 6 screens with financial news tickers scrolling past your eyes. It can be much simpler. Dedicate a little bit of time each week to learning. Read reputable financial news sources. Listen to podcasts about economics and market trends while you're commuting or at the gym. Follow trusted financial experts. And I mean actual experts, not some guy on TikTok promising you a guaranteed 1,000% return on a meme coin. Understand the products you are investing in. If you can't explain what a company does or how an investment product works in a simple sentence, you probably shouldn't be putting your money into it. This process of ongoing learning does 2 things. First, it helps you spot new opportunities that you might have otherwise missed. Second, and maybe more importantly, it helps you avoid making stupid mistakes. Knowledge is the ultimate defense against hype, fads, and outright scams. When you're educated, you can see past the flashy headlines and make decisions based on sound principles and solid data, not on fear or greed. Your brain is your single greatest asset in this journey. The more you invest in your own financial literacy, the greater the returns you'll see in your portfolio. So be a student for life. Your future self will thank you for it. Alright, this last tip is perhaps the most difficult yet the most rewarding. It's about patience and consistency. In a world of instant gratification where we can get food, movies, and dates with a swipe of a finger, the idea of waiting for something can feel ancient. But when it comes to investing, patience is a superpower. The stock market is not a get-rich-quick scheme, it's a get-rich-slowly and steadily machine. The real magic of investing comes from a little thing called compound interest, which Albert Einstein supposedly called the eighth wonder of the world. It's your money making money, and then that new money also making money. It creates a snowball effect, but it needs one crucial ingredient: time. This is where consistency comes in. It's about making regular contributions to your investments no matter what the market is doing. This strategy is often called dollar cost averaging. When the market is high, your fixed amount of money buys fewer shares. When the market is low, that same amount of money buys more shares. Over time, it averages out your purchase price and reduces the risk of investing a large sum at the absolute wrong time. It removes emotion from the equation. You're not trying to time the market, which is nearly impossible. You're just consistently, methodically building your wealth brick by brick, month by month. It's the tortoise, not the hare, that wins this race. And speaking of emotion, this is where patience really comes into play. The market will fluctuate, it will go up and it will go down. There will be days when your portfolio is bright green and you feel like a genius. There will be days when it's blood red and you feel like an idiot who should have just hidden their money under the mattress. The key is not to react emotionally to these short-term movements. Don't panic and sell during a downturn, locking in your losses. And don't get overly greedy during a boom. Stick to your plan, trust the process. Long-term thinking is what separates successful investors from the rest. Be patient, be consistent, and let time do its beautiful work. So there you have it, 5 foundational principles to get you started on the right foot. Set clear goals, diversify, understand risk, keep learning, and be patient. These aren't just tips, they are the pillars of a sound investment strategy. But remember, knowing the path is different from walking the path. It's easy to get stuck in analysis paralysis, endlessly reading but never actually doing. It's time to move from theory to action. It's time to stop letting your money just sit there, losing value to inflation. In today's world, you can't afford a so-so financial strategy. Don't settle for so-so. It's time to let your money work smarter, not harder for you. And that's where we come in. Here at Zimbudzi Investment Group, we're not just about giving advice, we're about providing opportunities. For those of you ready to take that first decisive step, we have an incredible offer to help you get started. We invite you to join Zimbudzi Investment Group today and take advantage of our exclusive 3-month fixed-term investment. This opportunity offers an impressive 12.5% return. Yes, you heard that right. It's a powerful, straightforward way to see your money grow in a defined period, perfect for building momentum and confidence as you begin your investment journey. This is your chance to put these principles into practice with a trusted partner by your side. Let us help you turn your potential into prosperity. Stop waiting for the right time, because the right time is now. Your journey toward real financial growth and lasting security is just one conversation away. Reach out to us, ask questions, and let's build your future together. Thank you so much for watching. We can't wait to hear from you.